Hi, everybody, and welcome to the Executive Buying Weekly Market Wrap for June 2nd, 2017. Let's get into it. This week we had to take off a loser, which was a company called WPX Energy. This company is in the oil sector, and oil has not been doing so well. So we were actually in a situation where we took off this 1175 level was our stop loss level, and it closed the week at 11 bucks. So we had to take that off for about a $2 loss. So we hung on there as long as we could. And I'm actually going to get to this at the end of the video on why it's so important to have risk management, take losses, and move on. So last week we had three winners. This week we have a loser. So be it. This is the way it is. It's not perfect. We know this. Moving on, we're going to be adding a company called Torchmark Corporation. They're a financial services slash life insurance company. This company's obviously been in a very nice uptrend. Okay, you can see here, this is a monthly chart that you're looking at. So every one of these candlesticks is 1 month of a trading range. And the company's director, Lloyd Newton, had purchased about $200,000 worth of the stock at right around the closing price where we have it here, around $76 a share. Okay. And what was interesting about his purchase is the last time that this director bought shares was in August of 2011, which is just about where this uptrend starts. So if you take a look right in this level here was his previous purchase. So you could look at it any time frame you want. The guy basically nailed the bottom. So I mean, if you look at it from a 6 month time frame, it went up 31%. If you look at it from a longer time frame, the guy nearly tripled his money. So once again, simple question. If you're up three times your money, why are you going to buy more? And the only answer to that question is if you think it's going to go higher. So we're going to add it to the focus list. We have a successful insider buying more shares after a successful trade. And TMK is what we're adding this week. Now, just to move on to the overall market. Now, here's the deal. Another monthly chart we're looking at, okay? Guys, we are in a bull market. There's no trying to get around it. You could take a look at this any which way from Sunday. We're trending higher nearly every single month, and we're in a bull market. So being long has made us money. Buying dips has made us money. Being short has been um, far and few between. That's why you don't see too many shorts coming on here because one, the market's not really calling for that. And secondly, I don't see a lot of successful insiders selling shares of their own company. Okay. So what we're looking at is an uptrend. This chart shows you from 2011. If I pull it out more, from 2009, you basically see a nice continued uptrend with moments of fear and pullbacks. But overall, we're still seeing more demand for the overall stock market than supply. So I don't know when it's going to end. I don't know how long it's going to go for. Uptrends and bull markets have gone for years at a time. So, I mean, it could literally go for another 2, 3 years. So don't try and call the top. If you're looking at this market from a perspective of, hey, if you look back this way, this is the highest we've ever been. So you got to get out here. It's at the highs. That's looking backwards. If you're looking this way, which we can't see very far, how high are we compared to where we're going? That's the question that everybody tries to answer and nobody knows. So what you want to do is you want to just take a look at what is the supply and demand of the overall market telling us, and it's obviously telling us people are happy to buy stocks at all-time highs because they think they're going to go higher. Now, just to go one more chart with you here. One weak point of the overall market. This is the ETF USO, the exchange traded fund for oil. You'll see in from July 2011 on this monthly chart down to today, oil really hasn't gotten going much. I mean, it's taken a big dive. It's calmed down a little bit. It's had a couple of bounces um, here and there, but overall, at best, we're basing. So it doesn't mean that, it can't go lower, and it doesn't mean that this is the bottom. I don't know. But the point is that in companies like WPX that we just took off for a loser, not really too surprised that oil can't get going. They're an energy company. We had to take a stop on it. So sometimes we're just going to get into bad sectors. Sometimes insiders are wrong, but about 66% of the time since we've been doing this newsletter, we've been correct. So that's the good news. Now, as we move on towards the end of the video here, I just wanted to really focus on risk management. Okay, why is it so important to have your risk managed, even if you take stop losses and then the stock bounces back? So what we have here is the light blue line here is Tesla, okay, and Wendy's is the green, and then we have Twitter in red, and the oil ETF USO in purple. So this is a couple of months of data, and if we were to say that we're going to put $10,000 into each one of these companies, okay, 10 into Tesla, 10 into Wendy's, 10 into Twitter, and 10 into USO. My handwriting is not the easiest thing to draw on this thing. So if we put $10,000 in this and we said, you know what, I am not going to lose more than 10%, let's see what happens. As we start to trade from this point moving forward, the first thing we see is that Tesla starts to separate itself from the pack. Okay. And then some of these stocks start to go lower. Now, this is our 10% line right here. Okay. And what we're going to see there is that the company that breaks below the 10% line is USO, or the ETF in this case. So we would have gotten out of USO with $1,000 loss. That stinks. Nobody likes it, but it's necessary. And the reason why it's necessary is because right now, if you stuck with USO the whole time, you would have had a 13.5% loss. Okay. So one, you're not sticking with negative pattern of a bad company or a bad ETF in this case. And secondly, there's an opportunity cost from this point moving forward. So what you want to do is you want to stick with the companies that are winning. And that's why if you stuck with the winners, like in this situation, we would have had $1,000 loss, but Twitter, we would have had a $1,500 gain. Okay. And then with Wendy's, we would have had an $1,800 gain. And then with Tesla, we had a $3,500 gain. So what winds up happening is that by the essence of managing risk, your losers are going to take care of themselves. They're going to tell you when it's time to get out. So you don't have to have that emotional back and forth of should I sell now? Should I sell later? Before you get into that company, you should be asking yourself, where is my stop loss going to be? Where is my risk management? Where is the point at which I say I am wrong? It's much better to have those questions answered before you get into it versus after you get into it when you have an emotionally charged situation where nobody wants to be wrong, especially with money involved. Nobody wants to lose money. So just think about this. I know it's a little bit of a sloppy chart here that I wrote, but the point is that even if two or three of these companies would have gone down 10%, you would, even if these Wendy's and Twitter would have gone down 10%, you still would have had a situation where you would have been positive with Tesla covering the small losses that you had in Wendy's, Twitter, and USO. So that's how it's supposed to work. Your winners are supposed to make up for way more than your losers. So if you're going to take a risk of one, at least try and gain two or three. So that way, as time goes on, you're in a position where even if you're right a third of the time, you're breaking even. Okay. So I went on a little long this week, but I thought it was an important point. Sorry once again for the sloppiness on the chart, but I hope I was able to get my point across. So have a great weekend. Enjoy the warm weather, and I'll talk to you next week. Sounds good. Thanks.